How would you interpret this latest GDP figure? Is it really world-beating, or is there more pain that's being masked?
That's very difficult to say. Of course, it is encouraging that there has been a recovery of the kind that you have described. However, the Q1, that is April to June GDP figure, is still somewhat lower than what it was 3 years ago. So we have to be somewhat cautious in our interpretations of what's going on. Having said that, of course, it is an encouraging recovery in April to June, especially in view of the really serious and terrible surge of COVID that we have had during those months. The bright spots in the picture are really the recovery of manufacturing and construction in particular. Being on the board of a couple of manufacturing companies, I have to say that I have been quite impressed by the kind of measures that Indian manufacturing companies have taken to keep their manufacturing activities in motion, despite the successive lockdowns that we've had in different parts of the country over those months. So it is encouraging. The 20%, 24.1% GDP growth that we reported in Q1 is slightly less than the consensus estimates. But nonetheless, I do think that is very encouraging.
And the RBI, they've chosen to stick to supporting growth and trying to see through the inflationary pressures that we have seen in India. Do you think that's the right call, or should they actually start normalizing policy?
Well, I think this also depends on what's happening in the rest of the world. As you know, the remarks of Chairman Jay Powell in Jackson Hole did suggest that they're still not signaling any kind of raise in rates, despite the inflation being higher. And particularly, producer price inflation in the US is in double digits, as it is in India. Our inflation, the CPI inflation rates, have been somewhat higher than the upper limit of the RBI's inflation target, that is around 6%. It's been somewhat higher than 6% for 4 out of the 7 quarters. So this is still a wait and watch situation. And we will have to be somewhat nimble in response to what happens in the rest of the world. I think for the time being, what they're doing is roughly what I would expect them to do.
Mr. Mohan, part of the reason for the sky-high inflation is sky-high fuel taxes. Is it time for the government to bring it down, or it's tough because it needs the revenue?
Well, exactly what you just said. It is tough because they do need the revenue. And therefore, I think that it would not be wise for the government to bring down the taxes on fuel because we do have, in fact, a long-term fiscal problem. One of the issues that I point out often, actually, is that the Indian tax GDP ratio hasn't budged an inch for about 12 years. In fact, the peak was in 2008-9, and we haven't reached anywhere near that since then. Therefore, the garnering of revenues is very important for the government of India and, of course, the states in India. And what it does mean, of course, perhaps is to enforce better compliance. I wouldn't suggest any increasing of rates, but I think that it would not be wise for the government to reduce fuel taxes at the moment.
When you take a look at the Indian market, it keeps testing new highs. There's a lot of money sloshing around. Retail investors are getting in on the act. Are you concerned about the disconnect between where growth is and where markets are?
Yes, indeed, because if you look at the Sensex companies, the PE ratio is now around 30. So I think that given any kind of global or Indian history, that you would expect a significant correction at some point. We also know, of course, that the Reserve Bank, in response to COVID, has pursued very accommodative monetary policy as well as liquidity injections, including the purchase of government securities on a regular basis. So it is still absorbing something like 6 trillion rupees a day in its reverse repo facility. And that gives an indication of the excess liquidity in the system. We also see that the growth in broad money has been lower than the growth in reserve money. And that itself also tells you that there's a push going on from the Reserve Bank side. Once again, I would hasten to add that that's not very different from what other central banks are doing in the world, but it does mean that we have to watch what's going to happen, and because of the accommodative monetary policy plus the liquidity policy, most interest rates are really in the real negative territory. So the policy rate is real negative. The 91-day T-bill rates are real negative. The 10-year G-Sec yield is just mildly positive. So that gives an idea of how accommodative the Indian monetary policy is right now. Once again, as I've said in a minute earlier, that I do think this is about the right thing to do at the present time. But the Reserve Bank will have to be very nimble in what they do in the months to come.
Mr. Mohan, in June, you wrote a paper for the Center for Social and Economic Progress and writing about this looming financial instability in India's banking sector. Can you elaborate what those concerns are for India's lenders?
I'm glad, as they say, I'm glad you asked that question. First, the Indian banking system has had very large non-performing assets since the early 2010s. We have been trying to address this issue through the passing of the Insolvency and Bankruptcy Code, which is indeed in action. So some things have improved. However, what has happened in the last few months after COVID is that we've practiced a great degree of forbearance. So at present, we actually do not know the extent of impaired assets in the banking system, which are bound to be significant given what has happened in COVID. Second, that there has been a very significant push from the government for the banks to lend to small and medium enterprises, other retail borrowers. And also some of the information that one has is that they are having some difficulty in collecting from these small borrowers. Now, the banks are somewhat protected because of the credit guarantees extended by the government. But I do think that just as we suffered the consequences of regulatory forbearance from 2010 to 2014 thereabouts, as the COVID pandemic goes, which we hope it does in the next few months, that we will then, I guess, next calendar year, start understanding what indeed is the impact of the regulatory forbearance and how many impaired assets the banks have. And therefore, this is certainly an area of concern, which once again, the regulator will have to watch very carefully.